Hi, I'd like to give you some help on how to solve a question, essential question number 4, version 3 from the fall of 2012. This is one of the ones that the class has already taken, but it'll provide you with some guidance on how to solve future problems. So first, what we're dealing with is a transaction when you have a purchase of a need. Now, this is like a Dr. Seuss thing I keep bringing back because it's something I can just fit in just about anywhere. The need is defined by the IRS to be a 5-year asset, and we have it out with a full cost basis of $10,000. The need is going to produce a small increase in sales of $2,000, but cost an additional $1,000 to operate. We're financing it with a loan, and please note the loan's only for $5,000, not the full 10 that's there, at 10%, and we have it have a single payment in year 2, and we anticipate selling the need in year 2 for $5,000. So we've got a really easy loan, we've got a sale, so there's probably going to be a gains tax involved. Let's go see how this all plays out. So the first thing that we'll do is we'll take a look at the operating revenue changes. So if you remember from back here, we said that the need was going to produce a small increase of sales of $2,000 and an additional $1,000 to operate. And so the way that gets reflected right here is that we have this increase in operating revenue, in each case of $2,000. Remember, positive means more in the usual direction versus the state where you do not have that asset. So we've got an increase in revenue of $2,000, an increase in operating costs of $1,000 in each of the 2 years that we own it. So that's the part that's reflected right there. Now if we move on to some other items, we were supposed to purchase the asset for $10,000 in year 1, and then we're going to sell it in year 2 for $5,000. So let's get to the cash flow statement component of that one. And so we can go down right here. We've got the need. The negative $10,000 is there in year 1 when you purchase it. Remember, it's negative because cash is flowing out. And the positive $5,000 is there. Remember, it's positive because cash is going in. So we've got that initial transaction. And then we have, moving over the other side again, we financed it with a loan at $5,000. And the interest rate on the loan is 10%. And that's designed to be something which is relatively simple to calculate. So again, moving down to the cash flow statement, we've got us taking out the loan. And so we have right there is the $5,000 of cash flowing in order to get the loan. And then remember, when you do loans, you have to split your payments up into 2 parts. And so we've got an interest expense up here in the second year, and we have the principal payment down here. So there's the $5,000, and there's the interest you're paying. There's the 10% of the $5,000. So at this point now, all we have to do is sort out what the depreciation is. So I've already shown you the depreciation is $2,000 in the first year and $1,600 in the second year. The Y works like this. The cost basis, as we said before, is $10,000, and we said also that it was a 5-year asset. So you got to do for the first year's depreciation is take the $10,000 and multiply it by the 20% that's right there in the table. 20% of $10,000 is the $2,000 that we have, over here in the income statement for depreciation. And please note that the depreciation bounces back down again into the cash flow statement because this is the special expense that isn't sent to anyone else. It's a check to yourself. Now the second year is a little bit tricky because then what you're doing is you're taking this $10,000 again, and when you multiply it by this 0.32 in the table, you end up with $3,200. But remember, you're supposed to be selling it in year 2. And in the year that you sell an asset, you only take half a year's worth of depreciation. You don't do anything funny like, this is accelerated or anything like that. You just literally cut it in 2. That's why when you look over here, we took that $10,000 times 0.32, cut it in half, and we have the $1,600 worth of depreciation in year 2 on the need. And remember that $1,600 bounds back down right here. So now that we've got all the data filled in, we have to go through how we got to this end result of net income, so we're going to do some sign convention there. And we also have to get to this gains tax, which is kind of a special calculation there, and then finally get down to net income. So we'll spend a little bit more time just on this income and cash flow statement. So first, operating revenue, you subtract off the operating costs, you subtract off the depreciation, you subtract off the interest, and what you should end up with is this taxable income. The negative $1,000 taxable income means that because you bought the THNEED, your taxable income is $1,000 lower than it would have been without in a world than it would be in a world without the THNEED. And then what you're doing with the taxes is, because we have this very simple tax regime in our class, we're just multiplying that change in taxable income by 0.4 and getting us a change in taxes. Now that negative 400 means taxes will go down by $400 because we purchased the THNEED. The negative $600 just comes from minus 1,000 minus a minus 400, and that gives us to minus 600. Something similar happens over here in the second year. It's 2,000 less 1,000 less 1,600 less 500. Remember, the positive numbers means that the interest or that value is larger in the usual direction. And so we end up with this negative taxable income of $1,100, 0.4 times that, and so we have a reduction in net income in the second year of $660. Both those two numbers bounce down into the cash flow statement. And so now that we've fully explained this chunk right here, we have no change in working capital. That wasn't something that we talked about, but other problems do have it. We've already shown you the changes in cash flow because of the purchase and sale of the THNEED, but now we need to get to this gains tax component right there. Now, usually in the cash flow statement, anytime you see something that's negative, that means cash flowing out. Well, for the gains tax, it's backwards, and what it means is that we've got cash that's going to be flowing into us for whatever reason. And the reason is that we're going to be selling this asset for $5,000, and that is going to be a little below the book value of the asset. So what you need to do in order to find out the book value is you take the original purchase price, which is $10,000, and if you subtract off $2,000 and you subtract off the $1,600, then what you end up with is the book value. Well, you bought it for, you sold it for $5,000. That's below the book value, so you're down to $8,000 and was it down to 64 or something along those lines? Anyway, you look at the difference between the book value and this 5,000 that's right here. You multiply it by the same tax rate that we've been dealing with, which is that 0.4, and that's basically the reduction in gains tax that you'll have for your entire business because you sold this asset and you sold it for less than book value. Now let's get down to the cash flow numbers. This one's fairly easy. All you got to do is add these guys up, remembering to reverse the sign right here. So if you add negative 600, positive 2,000, negative 10,000, positive 5,000, you should end up with negative 3,600. So that's cash flowing out over the course of the year, greater than it would have been without the purchase of the THNEED. And then if you go ahead and take the negative 660, add the 1,600, add the 0, add the 5,000, and then it's add 560 because the sign convention is reversed. Subtract 5,000, you'll end up with a positive $1,500 cash flow because of the purchase and sale of the THNEED in this particular time period. So it's versus what it would have been in the world without a purchase and sale of THNEED, without this particular transaction. In order to get the present worth, all I did was took the negative 3,600 and then took this 1,500 and divided it by 1 plus the interest rate, which is 1.05 altogether. We end up with a negative number, so we found out that this was a bad investment. And there you go. There is an explanation for essential question number 4, version 3 from the fall of 2012.